Hey guys, welcome back, welcome back, welcome back. This is the Very Cool FinTech Book Club, video number 2. As a reminder, we are reading Payment Systems in the US, aka the Glenbrook book. This is my second video, which means we are going to be covering the second quote unquote real chapter after the introduction, which is chapter 3, Core Systems Checking. Stoked about it, right? It's all about checking accounts. When I started, right, it starts out, it's like history and background. Like, here's your basic idea of what a check is. Uses the phrase negotiable instrument. I didn't actually know what that was, so I went ahead and Googled it. Google's not that helpful, right? So Google just shows here that like negotiable instrument refers to the fact that the note in question can be transferred or assigned to another party. Non-negotiable describes one that is firmly established and cannot be adjusted as needed. So that's basically exactly what it says in the Glenbrook book here. As a negotiable instrument, checks can be transferred from one person to another. So Google was kind of a bust on that one. On to the next highlight. I got excited by this, right? This is talking about demand deposit accounts, DDAs, more formal name for what we refer to as checking accounts. This is helpful. So in situations like Chime, we often refer to the Chime account as a full DDA account. This is in contrast to a prepaid card, right? So prepaid cards act kind of like checking accounts in many ways, but a full DDA, I mean, truly it's just a DDA account. The full is just sort of to emphasize, like, no guys, this is really an account. At Chime, we don't call it a checking account because checks cannot be drawn on a Chime account, but it is a full DDA account. And so I Googled this one too, just because I was sort of interested in what the technical definitions behind these things are. I ended up at the CFPB, and that says, right, so it's like, what's the difference between a checking account, demand deposit account, and a negotiable order of withdrawal account? It says a demand deposit account is just a different name for a checking account. There's this cool paragraph on the Federal Reserve Bank system. It says very specifically, right? It says the Federal Bank Reserve System, formed in the early 20th century, required its member banks throughout the country to accept checks for deposit at par. The book kind of moves on, but forcing its member banks to accept the checks at par strongly implies that before this time, at least some of the banks were not accepting the checks at par. So I went back to Google to kind of poke around there and see if I could learn, anything interesting. I ended up here at a short history of checks in the USA. And this was kind of cool, right? So it certainly talks about, says the writer's bank might pay for a check by sending another check to the remote payee's bank. I poked around a little bit more and I got this very cool JSTOR paper, historical analogy to the fight against par check collection. And I read through this whole paper. I recommend you do too. You don't have to. But I found it very interesting, which is basically checks. What it sounds like to me, I was still a little bit confused at this point, but what it sounds like to me is that checks charged a fee, banks charged a fee for cashing checks, basically because they could. And so what would happen is that if you go and you want to cash a check, it's a $100 check, your bank is only going to get you $98 because they're only going to get $98 from whoever wrote the check from their bank. And whoever wrote the check, their bank is going to be like, yeah, for sure, it just cost us $2 to pay this out. What are you going to do? It's the fee we had to pay to send these bills in the mail. So this was the exchange fee. So, but I mean, they didn't do this very often. And even here on the history, like it sounds like it was cut out pretty quickly. But I just got curious. I went down a whole rabbit hole. It took me like 30 minutes about reading about exchange fees for checks in the US. Now, it also talked a little bit about check encoding, right? I thought this part looked maybe kind of curious. It says check amount is added after the check is written, usually by the bank of first deposit in a process called encoding. Is this for personal checks too? Like where the amount is just written out? I was really curious how this encoding process happens because I literally cannot imagine any other way except for some teller is just like typing in the amount of a check and it gets printed at the bottom. It talks a lot about, right, the book talks a lot about the micro line, which is that line at the bottom written in magnetic toner that runs through the machines to help them process faster. At my last company, Pinch, we were printing checks and we bought magnetic toner in order to print that micro line at the bottom. I don't know if that was ever actually used, but we sure did. Now, this call out from payment system in the US is what actually helped me understand the exchange fee the best. So basically what this call out says is it says, some industry observers have suggested the Fed impose a similar at-par model on debit card transactions, which are analogous to checks, with the exception of the good funds and fraud guarantees provided by cards. The Fed was not persuaded to do so, resulting in increased lobbying efforts to secure legislation along those lines. The passage of the Durbin Amendment as part of the Dodd-Frank Act, passed by Congress in 2008, was likely influenced by these efforts. Okay, so first of all, biggest fangirl of the Durbin Amendment. So the Durbin Amendment does a couple of different things. One, it limits the amount of interchange that banks with over $10 billion in assets can charge on their debit cards. And the goal of this, right, was to increase debit card acceptance, to reduce the prices for merchants to accept debit cards, hopefully reducing prices for consumers, or at least pushing us more towards Europe, where Europe, everybody takes debit cards used for everything because the fees are so low. In the US, debit cards are often charged the same fees as credit cards, even though they're much less risk. And so the Fed was trying to control that with the Durbin Amendment. So it reduces interchange for banks with over $10 billion in assets. The other thing it does, well, it does a couple of different things, but one of the things it does is it says you have to have at least 2 unaffiliated networks on your card. So in Chime's situation, right, we have Visa as our front of card, and then we have unaffiliated secondary like PIN network that we use in addition to Visa's PIN network Interlink. And then the merchant gets to choose which of these networks they route the transaction over. So that's another one of the things from the Durbin Amendment. The at par model on debit card transactions, I think would be really interesting, right? So at par means interchange fees go to 0. Today they're limited. I think it's like 21 cents plus 5 basis points for banks with over $10 billion in assets. They're unregulated for banks with less than $10 billion in assets. At par, I literally can't even imagine a world without interchange fees. I also think that that implies that there's no risk for debit cards, and I don't think that that's true. But you could say that the risk is quite analogous to the risk presented by a check, and that banks should just figure out how to make it work. So I thought this was really interesting. This really helped me understand the exchange fee, because the exchange fee was charged by basically the bank making the payment, which is very similar to interchange, where that fee is charged by the issuing bank that issues the debit card. Back to the book. Okay, so now this what if was so cool. Got Dodd-Frank, says the 9/11 was the reason they finally pushed, I think it's a funny story, like finally pushed to like virtual check image processing, because without planes flying the physical checks through the air to the banks, the Fed had to float too much money. Thought that was sort of interesting. Here, so I thought there was a really curious kind of call out here. Basically what it says is that you can have, right, it's like banks either give you checks, so if you have a checking account, the bank will give you checks, or it's going to give you the routing and account number, and you can print that on your own checks, right? So like when Pinch was printing checks, we just bought check stock, and we printed our customers' routing and account numbers at the bottoms of the check, and it became a check on their account. I know that also it's quite common for businesses to print out their routing and account numbers. I don't think it's very common for consumers. I think it's asking a little bit much for consumers to be printing the micro line on the bottom. And you can do it with software. At Pinch, we didn't use software to do it. We literally, there's just like a micro font, which is digits 0 through 9 and a couple of special characters, and we just use that to print out the routing and account numbers. I did think this was interesting though. So as I mentioned earlier, right, Chime specifically does not offer checks. I don't know where in the process that we don't offer checks. Like, where does that work? I know there's this really cool website that I was playing around with called checkbook.io. I think it was started about the same time as Pinch, and everyone had been mentioned them, so we're quite familiar with them. Checkbook.io lets you link your bank account, and they will send a check through email or through physical mail to anyone you want. And then the recipient has the choice to enter in their routing and account number and basically get the amount of the check deposited as an ACH, or they can print out the check on their own. And then they have, I mean, it's on printer paper, right? But they basically have a check that they could present in person at a bank. They could take to a check casher. They could use remote capture to deposit to their online bank, a bunch of different options. So I poked around at this site and I tried to figure out, you know, if I put in Chime routing and account numbers, I do think that check would fail, but I don't know at what process it would fail on. And it's kind of interesting. All right, so it also talks, right, it said the bank of first deposit is under no legal or regulatory constraint to clear the check in any particular way. I just thought that was interesting. Like, I don't know, it's like, is there an opportunity for a startup here, right? In the fintech world, like, given that there's no regulatory obligation, is there a cheaper, faster, like, can we use technology to sort of like create competitive advantage for banks here? It goes on to talk about, so there's this, right? It says the deposit bank presentment decision policies were input to the check sorter, which slotted checks into various bins for clearing by various methods and to various paying banks, right? So basically, like, depending on the amount of the check, the riskiness of the check, it's like, do you want to like make sure you get this check faster, even if it's more expensive for you, or can we wait a little bit and we can get the funds like later and just like cover the float to, you know, our customer who deposited at our account. We just like let them have the money and take longer. I would have loved to have worked with whoever's writing this decisioning engine, right? And decides like, what are the rules? What are the trade-offs? Because I imagine that both, so larger check amounts are probably more painful for the bank to float. That's going to be a more expensive cost. I can also imagine that large check amounts are riskier transactions. And so you want to find out faster if this check is going to bounce or if it's good for it. Smaller checks, but I don't think it's that simple that you would just want to take a plane to send overnight checks to the writer's bank account immediately. I bet there's a lot of rules, and I bet you can make a really sophisticated fraud engine that takes a ton of different data to figure out like what is the way that we want to clear this specific check. So I would have loved, I don't know, if anyone has access to any of those rules, I think that would be super, super interesting. All right, it goes into a lot of stuff with check clearing. It talks a little bit about checks converting to ACH. This is one of the things, I think if you remember from earlier, I was actually confused because I often think of checks as ACH, and it looks like, compared to ACH, right, it looks like it's so common and so fast and so easy for checks to be converted to ACH. It's probably why I've had some confusion on whether checks are even different than ACH. Seems like they are, they just get converted. Not exactly sure how. Here, right, says the image of image clearing, and talks about how the time taken to clear checks has shortened dramatically, and they now clear faster than ACH or cards. This kind of blew my mind, in part because I think of card payments as being instant, although obviously they take usually a couple days to settle. I think of them as happening immediately because that authorization happens immediately. But it's still crazy to me that we have made this like very physical check instrument so fast at clearing with images and bank routing numbers, everything like that, that it can clear faster than ACH or card sometimes. I also thought this is kind of cool. It says a check can now be thought of as an upfront paper order to pay, a kind of one-time payment card. It almost reminds me of privacy.com's value prop around creating like disposable debit cards. Cruising through check economics, we get into business banking, we get into consumer banking. Right here it says, most large retailers encode checks and put the dollar amount on the microline to avoid bank charges for doing so. So this goes back to, right, I was curious about how the dollar amount gets encoded, and I was like, there's no way this, like, it just must be a teller typing this in. Here's another clue. It seems like not only is it a teller typing it in, but that the writer gets charged a fee, probably not in consumer banking, but in business banking, in order to do that encoding. And so that's kind of interesting. I also, a little bit down this page, right, it says retailers using a check guarantee service, the provider charges a fixed fee plus a percent of value charge. This makes the economics of the transaction similar to credit card acceptance. This actually really reminded me of a newer startup, Signified. And Signified is actually, it's like not even that new, right? Like I started using Signified in like 2014 or something for Roxbox. Signified is a really cool product. Basically, if you have an e-commerce shop, you run all of your e-commerce transactions through Signified. Signified sends back a risk score. If Signified, and it's basically a go or no go score on the transaction. They use all kinds of things, including like email age, the type of credit card used, stuff like that, in order to come up with their risk assessment. And basically, if Signified says that this transaction is a go transaction, and it ends up not working out, right? So like there's a chargeback on the transaction or something like that, Signified covers that. And you, as the retailer, you pay them a fee for every single transaction that you score with them. And then that's like the insurance product. So I thought that sounded like quite similar to this check guarantee service. So I don't know check guarantee services, but it seems like Signified is like the new e-commerce version of that. And I wonder if there's other examples of services that exist for people who accept checks, and if we can bring that to card payments, and if we can bring that to e-commerce, and if there's like cool business opportunities that exist there. Talks about other check products, talks about your losses and your fees here. If we dig into this, right, it says retail merchants need to determine if checks received will be converted to ACH. So this is the same thing, like my confusion here about are our checks ACH or not, different, they get converted, but seems like they're commonly converted and potentially at the cash register or point of purchase or in the back office. So it's just like another little hint there. It also, down here on the page a little bit, it says banks in general find these losses acceptable given the very lucrative non-sufficient fund fee revenue collected from their consumers. This just makes me mad. I think it's just annoying. It's like very lucrative. Like, why are we having consumers pay for this? You know, it's just outrageous and seems super backwards. Goes into technology and check fraud, stuff that the Federal Reserve is banking. Interesting piece of fraud, right? It's like if you deposit a bad check and those funds bounce, like your bank is going to try to recover this from you. Reminds me actually of a story. I needed access to a bunch of cash one time in college. And my friend had a bunch of cash and he didn't have a bunch of cash. Need access to a bunch of cash. Oh, I didn't have like a real bank then. I had a branchless bank then too. I've always had branchless banks. And so basically I was banking with Charles Schwab and I needed a ton of cash and it was beyond my ATM limits or stuff like that. And so what I did is I wrote my friend a check and he had an account at a local bank. So I wrote him a check for like $3,000. He goes to his bank account. I'm going with him. The two of us, we go to the teller. He deposits the check. The teller like types some stuff in. His account balance goes up by $3,000. And then he withdraws $3,000 from his account. Right, so he's using his teller like a check casher. It's a free check casher because he has a checking account there. And then he gives me the $3,000. And at the time, people were like, this was too easy. Like, it feels like there must be a gotcha there. Like, how am I able to effectively just take $3,000 out of my account, even though I don't have a branch? And the reason is his bank is really taking a risk on him as a benefit to him of having his as a customer, right? And so this is kind of a competitive advantage that they're doing is by giving him access to all the funds from this check immediately. They don't have to, right? That Reg CC, I believe, governs the availability of funds. And it's usually you have to do like $200 by X time frame and the full amount by some amount water. Actually, I think in June it changed from $200 to $225. Inflation, you know, what are you going to do? Everybody's got to update their systems. But we thought it seemed crazy, but really, so the bank is taking a risk on him. If my check bounced, they're going to rip that money back out of his account and they're going to try and recover it from him. So ultimately, he is on the hook, and it was very generous favor that he did for me as a friend. But it's explained a little bit by what I have learned from reading this book. And that's it. So quick chapter. Next video will be on ACH, chapter 4. Look for that. We have our first book club meeting ASAP. I'll post that too. And yeah, thanks for tuning in.